Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg. We spoke about the Fed minutes last night, and it turned out to be no surprise. Just further shows the resolve they are having in curbing inflation, putting investors on the caution seat. ECB continues to reduce their balance sheet last month with the reduction of almost 30 billion euros. And as of for India, we have observed services PMI rising to a 6-month high. Strong performance indications, while Citigroup was also seen cutting current account deficit forecast below 3%, have put India in somewhat different zone when you compare it with other nations. So, JK, what do you think of this strong domestic performance?
Yeah, good morning, Shikhar. Yes, I think my focus is also on the continued confirmation of outperformance on the domestic sector by India. And yes, services PMI yesterday at 58.5 from 56.4, beating expectations and beating the global trend. And global trend has been lower and it's been in contraction territory and we are in expansion territory. And of course, once again, this outperformance has made little relevance to the rupee trend. In fact, the stocks were also down, but that was more on a corrective note. The stocks have been rallying for quite some time, and it has corrected yesterday and day before. Rupee has continued to trade in the recent ranges. Contraction of daily ranges gives me a sense that a larger directional move may be nearing. In fact, it's very unusual that in a new year, rupee trades in such a narrow range. Given that the currency has been trading weak for a very long time, in fact, a year now, and we have seen almost one-sided flow, logically, one should see corrective strength. However, the continued external deficit, the latest evidence coming from higher CAD and lack of flows, upside for dollar looks more vulnerable for an eventual break. More so if we see dollar index regaining some of its steep losses of last few months. So we will watch 80 to 40 and 83 break with a daily close basis to confirm a fresh trend. On the global data front, the European PMI services held steady, giving a sense that the region may outperform better than expected, having tided over the energy crisis and milder winter helping. The composite PMI, SLP Global, seen as a gauge of economic health, rose to 49.3 in December from 47.8. The ISM report in US, on the other hand, showed a contraction once again from 49 to 48.4. Most importantly, the prices paid slumped by 3.6 points, and it's which is very comforting for inflation watchers. The prices paid pressure has posted declines for 9 straight months, suggesting that the fastest Fed tightening since 1980s is being met with intended drop in price pressures. Yes, of course, Fed will want to see that reflected in the headline CPI number, which will come later this month. The job market in the US also continues to confound us amid all contractions we have been seeing in the housing and manufacturing. JOLT survey shows demand for employment remained high, and the companies look for workers to fill their position. In fact, the job availability ratio to job seekers was at 1.7, and that's a staggering high number. The data does prepare the markets for a strong monthly NFP report on Friday, while we have more clues from ADP private jobs report also tomorrow. Meanwhile, there's been some negative news. As I said, it's a very mixed picture as far as the jobs market is concerned. Salesforce, a major US company, said it plans to cut jobs by 10% and close some of its offices as well, after rapid pandemic hiring left it with a bloated workforce amid economic slowdown. It doesn't gel with JOLT's data. And once again, we also had Amazon saying today that their job cuts could extend to as high as 17,000. As you said, the FOMC minutes, in fact, it turned out to be a damn squib. In fact, it confirmed whatever has been heard for quite some time now. Members acknowledging that they had made significant progress in the last 1 year, but still maintain lower pace of rate hikes to meet the target. Kashkari, the Minneapolis Fed guy, indicated rates should move to 5.4% before pausing. In fact, stocks have been, seeing a mixed performance. Asian markets, barring Japan, have been strong along with Europe, while US markets are yet to show signs of a new rally. Sentimentally, US markets are struggling because some of the major tech companies have lost market cap massively. Apple, after reportedly asking its suppliers to slow production of some of the components, and Tesla, after its quarterly delivery of vehicles falling to lowest since August 2020, roughly a 75% drop from its November 2021 high. In the last 6 months, Apple shares have lost 28%, while Tesla has lost a whopping 51.24%. And definitely, this is not helping the sentiment in the US market. One needs to wait and see if the US markets will catch up with the global markets, or it will drag down the global markets. At least the oil market is discounting a severe slowdown in the demand ahead of benchmark as benchmark crude crashed to USD 78 per barrel yesterday, recording a drop of more than 10% in 2 days. And it's the largest drop in the first 2 trading days of any new year since 1991. The slump is clearly due to concerns around China, COVID-19, and Fed forcing a global recession. Both of them are demand destruction events. Finally, there's some positive news on the globalization, with China's National Development Reform Commission close to deciding removal of ban on coal import from Australia. This helped Australian dollar rally nearly 2.5% yesterday and added positive risk sentiment as well. Technically, Australian dollar looks poised for more gains if it sustains above 0.6875. Currency front, I think after the massive move on the first trading day on the 3rd, Euro and GBP have maintained their, positive outlook, still holding above the supports, and there is some weakness in the yen scene. That is because risk sentiment improving. Overall, I think markets are waiting for the key data on jobs tomorrow before they make a directional move. Yeah, all the best for trading today. Thank you.
Okay, wonderful, JK. And yes, folks, I'd like to highlight, as JK mentioned, the kind of contraction that we are seeing for USD INR. The moment it breaks out of the range, it can give you a strong move on either of the directions. Whereas the continued outperformance for domestic economy is still something which is being observed by a lot many, because it's in contrast with the rest of the people around in the globe. Now, for US, if we have to talk about, demand for employment remains high, but at the same time, we are observing a lot of divergence when the layoff trends are being observed by the larger names, Salesforce being another name to be added onto the list. And talking about equities over there, significant drops in the tech stocks have continued to push sentiments on the concerning side. Whereas positive news, as JK mentioned, China working around the ban of coal imports from Australia has pushed Australia to rally. Now, folks, this is some interesting news which has led to a very good move for Australian dollar yesterday, and it needs to be seen how things go ahead for the pair going forward. But that's it for today, folks, and we'll come back again tomorrow with another round of updates. Thank you so much for listening.